In this video, I present to you the first part of a series called The Iceberg of Finance. For those of you who don't know, because iceberg memes seem to be more of a Gen Z type thing, an iceberg meme basically shows a topic, and this one is going to be financial markets. I mean, there's so much juicy stuff about financial markets. I probably could have made a whole nother iceberg meme just on these. That it's the top level is the surface level, family friendly, obvious stuff about the markets. They're kind of little fun facts. And then as you go down below the surface, just like an iceberg, the deeper it gets, the bigger it gets, and the darker it gets. And as we keep going down this iceberg layer by layer, it gets more crazy, it gets more dark, it gets more conspiratorial, or just unusual and unexpected. And the thing is, if I made this iceberg, I tried to avoid like unsubstantiated conspiracy theories. Basically, there's so much weird actual true things in the world of finance that I was able to make a very in-depth iceberg. And then there will be in the show notes, you could see the link to the image, and I showed it in the cover too of this video, of the full iceberg, so you can see all the topics we're going to cover. But for this video particularly, we're going to start with the first layer, which is the sky, which is above the surface, just the really kind of general facing things of finance. And we're going to go through these points, what they are, and why they matter, and just enough for you to start. If you want to deep dive into each of these topics, you can look them up. So with that begin, let's start with level 1, the sky level above the surface. So the first one we're going to be talking about above the surface is the idea of bulls and bears. It's common lexicon in finance that a market that's trending higher is a bull market. Generally, if it's a 20% or more off the trough, it's considered the start of a bull market, and it ends if it suffers a contraction of more than 20%. And how about bear market, which is the exact opposite? It's a contraction of 20% or more, and it ends when you have a 20% or more rally. I mean, those are the technical definitions, but generally, is it a time where investors are adding risk and prices are going up, or investors growing more cautious, taking off risk, and prices are going down? So why are they named after these two animals? There is no defining theory or proof of historical record of any evidence that's like, this is the thing. But there are a few ideas out there. These terms started to be used in the 16th and 17th centuries originally. There was a popular spectator sport, if you call it that, during these days, called baiting. It's where you would tie a wild animal and have it be like harassed by dogs or be forced to fight other animals or people or whatever it is. And people would just watch this for entertainment. And bulls and bears were two popular animals that were used for this sport. And I think that maybe a bull market refer to is that the bull was more likely to be used in good times because the animal maybe wasn't needed for meat, or maybe the motion that a bull attacks is through charging up with its horns. Maybe that's why they use the bull. Whereas a bear, people don't really necessarily eat bears or have other uses for bears, so when times are tough, maybe you couldn't use the bull for baiting, and so you could use the bear instead. And also, bears tend to slash down, and so maybe that is why that bears are used for when it's a bad economic environment. The other origin story is that in the 1700s, the proto short sellers were known as bearskin dealers because they were selling the skin of a bear before they hunted the bear and took it off, which is kind of like what a short seller does in the sense that they sell the shares that they don't own. And so these bearskin sellers over time just became referred to as bears, and therefore a bear market. there isn't really no similar other or counter origin story for bull market. So it seems like that's the bull baiting and bear baiting is the closest thing, but otherwise this is just a mystery. The next thing is Wall Street. Wall Street is not just a single street in New York, where it is a street in the southern tip of Manhattan, but that it also is a term that is kind of like Silicon Valley, where it extends beyond the geographic area of Wall Street. Or Silicon Valley is not just people who live in the area of San Jose, California, and the surrounding cities. It refers to anybody who works in hypergrowth tech or a big software company or big tech hardware company that is in the United States. That is now Silicon Valley, even though it may not actually be. There's the physical place still too, but it's also just a catch-all term for anybody who works in high tech. The same thing with Wall Street. Wall Street is a street where the New York Stock Exchange is on. I've walked down it several times when I've visited New York. However, it also refers to anybody who works in capital markets, whether it's asset managers, traders, investment bankers, people who are professionally involved in investing, speculating, or brokering deals in the capital markets. That is Wall Street. So you have people who work in Wall Street professions all over the country. I live just about as far away as you can from Wall Street in the 48 continental U.S., yet I'm still a Wall Street professional. The name Wall Street comes from the fact that when New York was still part of New Netherlands, the Dutch colony, the Dutch citizens built a wall on what is now Wall Street, a wooden palisade wall to protect from an invasion to the north. Didn't do any good because the Royal Navy just sailed into their ports from the south and captured New Amsterdam anyway, which was changed to New York. The wall was torn down once the British came in because the wall was designed to protect the Dutch from the British and was no longer needed anymore. And where the wall used to be, there became the street Wall Street. And why is Wall Street the place that finance is regarded? It's because that's where the New York Stock Exchange, or what used to have, was eventually built. But before there was a stock exchange, there was a beech tree near a church on that street, where the laws of the city at the time is where securities dealers would go to exchange their goods with each other in trade. That was like the designated spot, was this beech tree. And as the industry grew, they needed a proper building to do it in, and it evolved into the stock exchange, which is just hanging out by a tree. So that is all about the origins of Wall Street. Funny thing is, though, is that especially with technology over the past 30 years and the internet, the physical place of Wall Street has continued to get less and less important, whereas like the financial industry and cap trading is done just about everywhere. In fact, even due to a lot of tax policies and suburbanization, you see, it started with hedge funds going to Connecticut in the 80s, but it's now growing to a lot of banks and other firms are now moving to Florida and Utah and Texas and a bunch of other places. So Wall Street's everywhere now. It's not just the street. And that leads us to our next topic, is the Rule of 72. The Rule of 72 is basically a shorthand for the time it takes for an investor to double their money depending on assumed rate of return. So what you would do to solve this formula is 72 divided by your expected return is how long it's going to take to double your money. So if you get a 2% return per year, it's going to take you 36 years to double your money. If you get a 10% return a year, it'll take you a little over 7 years to double your money. And this just shows the power of compounding. When you can consistently get compounding good returns, your money grows a lot faster. It's not what happens in one day, 1 week, or even 1 year. It's really wealth grows just through compounding. And the rule of 72 is just shorthand for how much time to use, or a reasonable amount of time to expect to double your money. Given, let's just say, the stock market's historical returns is 8%, so it should take you about 9 years to double your money if you put it in a stock index by the logic of the rule of 72. Speaking of compounding, that's the next concept on the sky level of the iceberg. Compounding is the idea that you could have your returns compound on each other every year, so that you end up making a lot more money on, even though the percentages of your returns every year stay the same. So if you put, say for example, a penny in the bank in the year 1600 and you had a 2% return every year, that doesn't sound like much, but if you compounded that over time, then by now you would have all the money in the world. It's the same with like, say if you put, for example, you got 2% a day on $100,000, you would have all the money in the world probably within 2 years. Compounding is powerful, and the faster you compound, the more powerful it gets. But there's other implications to this. Like when anybody promises you that you can consistently get 2% a day trading, that's probably not true. Just because, as I've told you, if you put in just even $1,000 and you got 2% a day every day for a year, so 1.02 to the 365 times 1,000. Yeah, 1,000 would turn into $1.3 million. If you did it with 10,000, be $13 million. And you don't see any of these day traders, so starting with their $1,000 to $10,000 accounts, they're not all millionaires over a year. If they were, then nobody would work, and all these systems that people sell would basically replace the need to actually produce capital or supply labor. And that's like maybe the negative side of compounding. But the positive side is that if even at much lower rates of return, say like the best hedge fund guys do, is they get 20% a year, like the Warren Buffetts and the Sam Druckenmillers, like the real best investors. And if you get 20% a year over 20 years, you're going to get 38 times your money. So if you put $100,000 and got 20% a year, that would turn into $3.8 million. So that's how you expect your retirement. That's how your retirement does go through saving more too, but it's the power of compounding is it really allows true wealth to be developed. And it's also why social mobility, people are afraid of, is kind of low, because it's a lot easier to compound if you have a bigger amount to compound with. Like, it's just, eventually, if you have long enough of a time frame, things work out. And I think that's the other thing about compounding. The other reason why we have this so-called wealth inequality now is people are simply living longer. And because they're living longer, they get to compound their wealth over a longer period of time before it gets cut by either estate taxes or dividing it up a large family. So compounding explains a lot of how finance works and wealth grows. And you want to use compounding in your favor versus against you. Like if you're borrowing and you keep paying interest on something, that's the power of compounding working against you. Like when you get a mortgage, you end up paying almost the same, like at least half the amount of the principal of the house in interest payments, just because it doesn't sound like 2%-3% a year doesn't sound like that much, but over time, it's just years and years of paying that interest. It compounds, and and this is how also credit card people get debt in trouble. It's not that much 1 year, but over time, that interest you pay compounds, and that's why banks historically have been able to make so much money. Whereas if you're an investor and you have that your compounding is working on your side, and you gain from your interest payments that you were receiving for your returns on equities or real estate or other assets bound every year, and that same factor that works against the borrower works in your favor. It's not quite this straightforward because you have to factor in inflation, but overall, compounding is a powerful force and it drives the entire financial services industry and the global economy. Albert Einstein even said the eighth wonder in the world is compound interest, and I think he's right. The next thing we're going to be talking about on this iceberg is IPOs. IPOs are initial public offerings. Like if you are a business and you're growing fast and you need to raise some money, but you don't want to get into a bunch of debt or the banks don't trust you for some reason, you would do is you could float your shares public in the form of an IPO. You get an investment banker, they put together all the legal things, they go on a roadshow to get the initial amount of investors you need interested in your stock, and then once that's all done, you go ring the bell at the NYSE and you're public and your stock is trading on the stock exchange. IPOs used to be the only way you go public, but now, or spin-offs if it's an already public company. But there's been other methods over time that have grown more popular, such as reverse mergers, SPACs, which we talk about level 3 of this iceberg, and direct listings, where a company they don't need any money, but they offer to float a portion of their shares as listings so that insiders and early employees who have made newfound wealth staying with this fast growing company can have the opportunity to cash it out. IPOs historically have like a big bounce on like 5 to 20%. It's a lot of people try to trade IPOs just by buying in before and selling right the day of. It's more popular on the retail level because for institutional investors there are compliance headaches with dealing with IPOs generally. But the reason why you see this phenomenon is sometimes a product of market sentiment, which will make the premium pop even more. Like there's some IPOs where, like Snowflake, I think last year or 2 years ago, where it had at one point like over 100% on the first day. But so the magnitude of this is because of investor sentiment, but the reason why you usually get a pop is because the bankers underprice the stock historically as a means to make sure the deal gets done and that the market shows a positive response initially to the IPO, because nothing looks worse for an investment banker than seeing an IPO crash on the day it goes public, because then future companies who are looking to IPO will be like, hey, this bank, they're clearly not doing something right because my stock is crashing on the first day. But it's at the same time, you could argue that maybe those bankers who are doing a better job because they got you an above market price. Whereas if you have a huge pop on the IPO, it means that you got undersold and you could have raised a lot more capital with that same amount of equity. So there's two different ways of looking at it. That's an IPO is a whole nother debate, but yeah, that's what I have to say about IPOs. And the next one, the origin of the capital markets. So why did the capital markets emerge in the first place? Why do we have things like stocks and bonds? If you want to learn more about this, a good book to read is Neil Ferguson's The Ascent of Money, which I will put a link to in the show notes of this video. So the capital markets emerged for different reasons. The first one we'll start with is the bond market. Bond market was mainly a necessity of modern warfare. I mean modern, I'm talking about like Renaissance Italy is where the modern bond market really started to develop. These cities had a longer term sustainable income due to trade and other things, but they didn't have the population base to supply enough taxes in the near term to cover their wars without killing their golden goose. But they also needed the money to fight these wars, otherwise they would no longer be an independent city-state. So the Medici family was part of this, but there's a lot of others who's like, look, we need to float bonds. We need to. I mean, there's plenty of wealthy people in our city that that have the capital for this to help finance this war, but the thing is that there's got to be a way to have them voluntarily contribute, and the way they've done that is through the bond market, where you would basically, instead of having to borrow it all from a single bank who did not have the resources to take on an entire government's debts for a war, or taxes in the near term, there's not enough tax revenue to cover it. Bonds offer a way to pool the financing of the cost of the war. So instead of, like, say for example, they needed to raise 1 billion of Florence silver pounds. I don't really know what the currency they used over in Renaissance Italy. And they do that, instead of they can issue that by splitting that million silver pounds into bond contracts of 10,000 each. And by doing that, they can have 100 buyers each buy one of those, instead of having one person have to take on the whole risk. And then you can divide it in smaller pieces too if you want a bigger crowd. And that's how bond markets work. Like, for example, the U.S. runs $1 trillion+ deficit every year. There's nobody who could take that on by themselves. Not a single bank, institutional investor, or individual who could take it on entirely on their own. And so we split the U.S. government debt into pieces known as bonds. And this started with the wars in Renaissance Italy, and it spread everywhere because it worked really well for the Florentines and those other, and so that's why we have a bond market. Why do we have a stock market? Stock market was kind of like a similar need to pool capital, but instead of governments, it's private businesses. And back then, private businesses were not considered the most creditworthy institutions. In fact, governments were barely creditworthy. You'd be amazed looking at interest rates historically in the eras of the Rothschilds in the 17 and 1800s. They were considerably high. And the default rates for sovereign debt during all the revolutions going on in Europe in the 18th and 19th century were seriously pretty high. And so if government bonds were not considered risk-free like they are today, why would you lend money to a private business, which is even more risky? So the Dutch came up with this idea of pooling equity. This originally started as joint stock corporations. That's where the term stock comes from. In many other countries, they call it the share market, because that's really more what it is, that you have shares. A stock is essentially a share of a publicly traded company. And so if you finance things such as the Dutch East India Company or the first colonial expeditions in England, you would sell shares of these joint stock companies and to pay for the project, and you'd get a bunch of members of the British nobility and other wealthy individuals to each buy a share instead of the whole thing. A similar reason with the bond market originated. There wasn't a single investor or whale out there who could put the bill by him or herself. So instead, you had to pool out the equity, and that's why we have stock markets today. Companies needed to raise money for various reasons, and therefore you have stock markets to help be able to facilitate that and have it easier, because it's easier to get a small amount for a bunch of investors than a large amount from a single one. Until about the emergence of SPAC IPOs, share issuance had been down for a long time because of private equity getting involved earlier and earlier, and these big institutions willing to write bigger checks up front. But then as there's been more enthusiasm in general for stocks, and particularly tech companies at any price, a lot of companies are now skipping the private stage and going straight to public, because the valuations are now higher in the public markets than they were in the private markets, whereas this was the reverse about 10 years ago. Things are like this, move in cycles. And the insurance market, how did that start? Well, the insurance market actually started as an orphans and widows fund for Scottish clergy, and that is how we got insurance, because basically they had an agreement that people had to pay in for a certain amount so that like if you died, your wife and kids would have something to live off of. It was kind of like life insurance before life insurance. So and this eventually came for other communities, developed these mutuals too, outside just the Scottish clergy and throughout Scotland and England. And that's how the origin of the insurance markets came about, is that basically people died for either because of wars or disease, or just life expectancies were generally lower. So, but they often left behind wives and kids who couldn't support themselves entirely. And so that's how this thing evolved. And the applications of it have grown over the centuries, and insurance companies remain a big source of capital and a big profit driver in the financial economy today. The last one I'm going to talk about for this one is Dogecoin, or Dogecoin as some pronounce it. Dogecoin is a really weird story. It was created by some software developers in Silicon Valley as a joke, mainly as a way to be able to easier transfer poker winnings among themselves. Also, there are some ideas to use it as a way to pay to give gratitude, kind of like Reddit Gold, to various comments on various internet outlets. And it, thanks to the endorsement of Elon Musk, which we'll get to my views on Elon Musk when we go deeper into the iceberg, Dogecoin took off from being worth nothing to 60 cents, which doesn't sound like that much, but it put its market cap at well over $50 billion, and it was worth more than a lot of major U.S. companies, such as major airlines and major food producers and retailers. At one point, Dogecoin was worth more than Marriott hotels, for example. It was crazy, and it was literally designed as a joke. I'm not going to get into the merits of crypto. You can watch my other video, which I'll have in a little caption here if you want to hear my thoughts on that. But it's and then like it kept going until it was well hyped about a couple months ago when Elon appeared on Saturday Night Live, and they thought, oh, this was going to be the coming out party for Dogecoin. But then, like, he came on there, and everybody who bought in anticipation of his big pump up lost. Dogecoin crashed 50% the rest of that weekend because there was nothing left to it. That's the lesson of buy the rumor, sell the news, was learned by a lot of Dogecoin speculators who probably didn't have that much history as professional traders. And it still has a positive value now, believe it or not. And people will just say on internet, like just TikTok and social media, like, oh, Dogecoin to the moon, because like the world is crazy and stupid enough that why can't the craziest and stupidest asset go up? And that's kind of been the mentality. It's the meme of memes. And speaking of Dogecoin, the other funny fact about it is that if you put your money last January 2020 into Dogecoin between then and April 2021, the return you got on Dogecoin, which was I think well over 10,000%, was more in that year and a half than if you had put your money in the S&P 500 for the last 30 years, which is mind-boggling. That just shows you that shows you the power of like the fact that, I mean, the power of compounding, I mean, in terms of daily returns, but that is a crazy story. What turned into a joke has made and lost people billions of dollars over the last year. That concludes the surface level, sky level of the iceberg. Next time, we're going to go to the surface level, where it's the iceberg you could see above the water, where we're going to still get into some pretty normally accepted topics, but they're a little bit more in depth and a little bit more obscure than the stuff we've talked about on the sky level. If you like this, please like or subscribe, write your thoughts in the comments, and I'm going to probably do another 7 of these now, because I was originally going to thought about putting 2 of them in a single video, but this is the most surface level one. Yeah, I'm already over 30 minutes into this, and these other ones are much more complicated concepts, and I often have more things to say, more terms, so we're probably going to have to make longer videos for the future Iceberg of Finance. And again, we have the link to the original image in the show notes for this video. Feel free to share, and just also know nothing in this video is investment advice. This is just it's a fun little thought experiment, explaining some of the oddities and facts and figures and interesting little tidbits that go on in the financial industry. Thanks for watching, and enjoy the rest of your week. I look forward to diving deeper into the iceberg of finance with all of you guys in the near future.